YouTube, how are we doing? So welcome back to the channel, and more specifically, welcome back to part 2 of the market structure Masterclass mini series. Now, if you haven't already watched part 1 of this series and also read the free PDF that we included, I would highly recommend that you go back and watch that video first. Just click the link above, as this video will make a lot more sense if you take the time to do that. Okay, so if you've already watched part 1 and signed up for the free PDF, you should have automatically received the part 2 PDF. So do go and check your inbox. And also, I will be giving away 3 one-to-one coaching calls as soon as this video hits 1,000 views. Okay, so all you need to do is make sure that you are subscribed to the channel, like this video, and leave a comment below, and there will be 3 random names selected once we hit 1,000 views. Now, in part 1, we covered some fairly basic concepts of market structure, including how to correctly identify swing highs and lows, how to use a mechanical framework when mapping out our structure, and of course, really digging into internal structure concepts. But everything we looked at was simply focusing on one time frame alone. So in this video, we're going to take it that one step further so we can really start to understand the relationship between different time frames, which, ladies and gentlemen, is where the magic starts to happen. Now, as I promised in part 1, if you apply these concepts to your own trading, you will automatically increase your strike rate, as you should know whether or not you're trading with or against the higher time frame trend. You will also significantly increase your risk to reward, as once you establish the true higher time frame direction and overall trend, and then learn how to navigate your way through the intraday price action to accurately time your entries and catch those turning points in the market, you are then able to capitalize on those large higher time frame runs, having entered with extreme precision, resulting in those crazy risk to reward trades. So by using multiple time frames opposed to just one time frame, like in part 1, it's like having the complete story, right? And true understanding of what is happening, which, as I say, will allow you to accurately time your entries so you can catch the very start of a new swing leg. But it also allows you to acknowledge when the swing leg might be finishing and when perhaps it is time to start closing out of positions, as you begin to see the lower time frames shift, and therefore maximizing your risk to reward and overall trading returns. So if you take the time to really master this and understand how to effectively analyze multiple timeframes, this is the moment you will dramatically improve your skill set, taking your trading to a whole new level. Okay, enough waffling, let's get straight into it. So, multi-timeframe analysis is exactly what it says on the tin. It is simply the process of analyzing multiple timeframes in conjunction with one another. It all starts from building the story from the higher timeframes first, all the way down to our lower timeframes. And a very simple way of understanding this would be, the lower you go, the more price action you see, and the more price action you see, the more information you gather. And the more information you gather, the more confirmation you have, right? Another way to interpret this would be to think about zooming in on a high resolution image. So let's take the world, for example. If you're looking at Earth from space, right, and you see the whole world as one, with all of the continents together in essentially one big, beautiful sphere, you can then start to zoom in and notice individual continents. And then you zoom in again and you start to see individual countries. And then you zoom in even more and you start to see counties and states within those countries. And then zooming in again, you can start to see cities within those counties. And within those cities, you start to see districts. And zooming in on those districts, you can now start to see roads and buildings. And then zooming in even more, you can now start to see trees, traffic lights, and us humans. So simply put, the timeframes that are available for us to use are there to view data in more resolution. Okay, so we can think about timeframes as a zoom or magnification tool as we move from the higher timeframes all the way down to the lower timeframes, viewing the same price data but in more detail and more resolution. So, as we're learning, multi-timeframe analysis starts by looking at the higher timeframes first. Now, the reason we start by looking at the higher timeframes first is the higher timeframes, such as the monthly or the weekly, for example, take much longer to form and therefore are going to hold a lot more information, right? Now, depending on your trading style, your higher timeframes might be the monthly and the weekly, and your medium timeframes might be the daily and the 4-hour, and your lower timeframes, where you would essentially execute from, might be the 1 hour or the 15-minute. Now, if you're someone that is a bit more of a session or day trader, your primary timeframes might look something like this instead. Okay. Now, we're going to talk about primary timeframes in a bit more detail shortly, but for now, this should help us visualize how the lower you go, the more information you see from a top-down analysis perspective. Okay. So if we were to look at one whole weekly candlestick, for example, you can imagine there is a ton of information within that one candlestick, such as the daily and the 4-hour, all the way down to the minutes and the seconds, right? Creating all of that order flow within that one weekly candle. So as you can see, one single weekly candle is made up of 5 daily candles. Now, that's just the FX market, by the way, because the crypto market is open 24/7. So one daily candle is made up of 6 4-hour candles, and one 4-hour candle is made up of 16 15-minute candles, and then one 15-minute candle is obviously made up of 15 1-minute candles. Okay, so as we've learned, the higher timeframe candles take much longer to form, which means they hold a lot more information within them. So as we really start to zoom in and work our way down into the lower timeframes, this enables us to be extremely accurate when it comes to timing our entries on the lower timeframes, but still being aware of the prevailing higher timeframe trend, allowing us to ride the direction of that large order flow. Okay, so hopefully you should now be quite familiar with this diagram, which is of course a price model representing a bearish trend, making a series of lower lows and lower highs. Now, as we covered in part 1 of this masterclass, a lower high is only confirmed once we see a break of structure, and we just expect these lower highs to be protected because they are strong highs that took out weak lows. And we just assume that this trend will remain bearish until that expectation fails, until price switches bullish and takes out that strong protected high. Now, this trend is made up of a series of runs moving with trend and runs moving against trend. So these runs can also be seen as impulse and corrections, as in a bearish trend, we will typically see fast moving, strong, impulsive moves to the downside, right, with trend, followed by slower corrective pullbacks, which are obviously against trend, followed by stronger impulsive moves to the downside with trend, followed by slower corrective pullbacks against trend. And this is the natural progression of the market: impulse, correction, impulse, correction, impulse. Okay, so all of these runs collectively make up a trend. Now, notice how we are essentially just looking at one time frame at the moment, which of course is the black line. So what we're now going to do is introduce another time frame into the mix, which is where the magic starts to happen, right? As we look at things from a multi-time frame perspective. So here you can see that we have a higher and a lower time frame. So the black line being our higher time frame and the blue line being our lower time frame. Now, a higher time frame is not necessarily one specific time frame, as this will differ from trader to trader depending on your personal style. But simply put, a higher time frame is any time frame that is higher than the previous, right? So for example, the daily time frame is obviously higher than the 4-hour. Now, remember in the previous diagram, I explained that a trend is made up of a series of runs moving with trend and also against trend. So when we think about this concept, but from a multi-time frame perspective, we can see that a higher time frame run is in fact a lower time frame trend, right? So a higher time frame run is in fact a lower time frame trend. So what does this actually mean? Well, we can see that the black line, being those higher time frame runs, are making up a series of lower lows and lower highs. Now, within those higher time frame runs, if we were to then look at a lower time frame, we would typically see full trends within those higher time frame runs. So let me explain. Starting here, we can see that our higher time frame is clearly bearish, making a series of lower lows and lower highs, right? Exactly the same as the first diagram. So this first sort of pro-trend impulsive leg to the downside, it creates a low. Price then starts to pull back, which is the corrective counter trend pullback. We then get another impulsive leg to the downside. We get a break of structure, taking out that weak low, which then confirms our lower high. We then get a counter trend corrective pullback. We then get another impulsive pro-trend run to the downside, taking out that weak low, okay, which then confirms our lower high, so on and so forth. So yeah, that's the higher time frame story and trend. Now, within the higher time frame runs, we can obviously see much more going on with trends forming within those higher time frame runs. So within this first higher time frame bearish run to the downside, we can see that the lower time frames, right, being the blue line, were in fact making a series of lower lows and lower highs. Now, because the market's a fractal, what happens on the higher time frames must first happen on the lower time frames, okay? So what we'll see in a higher time frame bearish run is the lower time frames making a series of lower lows and lower highs, and then as the higher time frames start to pull back, we will first see the lower time frame switch trend, okay? Now, I'll just say that one last time. In this bearish higher time frame run to the downside, the lower time frame trend will be making a series of lower lows and lower highs. So once the lower time frame then switches from bearish to bullish, that is our signal that the higher time frame pullback is now in play, okay? So now the lower time frame has switched from bearish to bullish because price has taken out that strong protected high. We've had a break of structure. We can now look to follow the lower time frame structure, and we can look to catch these higher lows, right? So now the lower time frame structure is bullish, making a series of higher highs and higher lows. And then as soon as the lower time frame trend switches bearish again, taking out that strong protected low, our higher time frame and lower time frame trend are now aligned, and we would just expect the lower time frame trend to remain bearish until it switches bullish again. So as you can see, we have our protected lower highs in place, and we can just look to try and catch these lower highs following the larger higher time frame trend. And then when the lower time frame trend switches bullish again, that's our signal that it's likely the higher time frame pullback is now in play. So then the lower time frame structure switches bullish, making higher highs and higher lows to facilitate that higher time frame pullback. And again, when the lower time frame structure switches bearish again, okay, now we have structural alignment between the higher time frame and the lower time frame, and then we would just expect the lower time frame trend to remain bearish, so on and so forth. Okay, so if this concept hasn't fully clicked yet, don't worry, we're going to have a look at some different examples in just a second as we start to piece this all together. So here we're looking at exactly the same price model, but we've just layered on the concept of strong and weak highs and lows. And as we know, the higher time frame structure is in black. So here we have our strong protected swing highs, right, because they have taken out these weak lows. And then looking at the lower time frame trend in blue, here you can see that we were clearly bearish, making lower lows and lower highs, meaning that these highs were strong and we expect them to be protected. And then as you can see, as soon as we switch bullish here, right, we then expect price to remain bullish. So then when we get a break of structure here, this then becomes a strong protected low, okay, and we continue bullish, and then we would expect this strong low to hold. And then as soon as price breaks it, that expectation has failed, okay, so then this high becomes strong. Okay, so we want to obviously trade away from strong legs. So price pulls back, this high then gets respected. We then get another move to the downside, breaking structure, and then this high also becomes protected, so on and so forth. And then we just expect that to continue until that expectation fails, and then price switches bullish, okay? Because we have taken out that strong protected high, we've now switched bullish, and then we would expect this trend to now continue bullish until that expectation fails again, so on and so forth, okay? So hopefully that all makes sense. Now, this little diagram here should nicely summarize what we've been through. So lower time frame price action forms higher time frame price action, which creates higher time frame runs, which are lower time frame trends, right? So it's those higher time frame runs which are made up of lower time frame trends, which is the fractal nature and never-ending cycle of the market, as the same patterns repeat themselves over and over again. So what we're now going to do is expand on the idea of using primary timeframes in order to make your multi-timeframe analysis as mechanical as possible. Because if we are consistent with our approach, we should have consistent results. Okay, great. So what does this actually mean? Well, when you're analyzing the charts and cycling through multiple timeframes, it's very easy to fall into the trap of utilizing various different timeframes at your disposal in the attempt to try and make something fit, to the point where you almost forcefully are creating a bias, right, that fits your own narrative. Now, if you've been trading for a while, you've probably fallen into this trap, like I certainly have in the past, where you end up almost becoming overwhelmed with all of these conflicting biases. So in order to give ourselves the best possible chance of achieving consistency, we need to be consistent with our actions and approach. Meaning that when we are playing a game of random outcomes and probabilities, such as the world of trading, it is our job to be as consistent as possible with the few varying factors and actions that we can actually personally control. So by reducing the amount of timeframes that we analyze, we decrease the possibility of conflicting our biases, which increases our level of clarity and focus to limit the amount of varying factors and discretion from our trading, which then reduces the amount of decisions we have to make, right? So ideally, we want to be using 3 primary timeframes to help create our narrative, guide us through the day-to-day price action, so intraday, and timing our entries with as much precision as possible. So this can be broken down into a higher time frame, a medium time frame, and a lower time frame. So our higher time frame in this example could be, the daily or the 4-hour, and we'd use this for our overall narrative and higher time frame perspective. And then our medium time frame could be, the 4-hour or the 15-minute for our intra-session or intraday bias. And then our lower time frame might be the 15-minute, so the M15, or the 1 minute, which we would then use for timing our entries. Okay. Now it all depends on your personal style, your work constraints, and just how you want to trade the market, because some people might use the daily for their higher time frame, the 4-hour for their medium, and then enter on the M15. Others might use the 4-hour for their higher time frame direction, the M15 for their intraday kind of bias, and then the M1 to time their entries. Okay, so really it all depends on what works best for you. Now, if you're not already using this concept of having a few key timeframes for your analysis, I would highly recommend that you just have a think about what timeframes are going to work best for you, and try to make your trading plan fit around your current lifestyle and not the other way around. If you're someone that has a really busy work schedule, don't try and enter on the 1 minute. You need to probably take a little bit more of that longer term approach, just so that it doesn't conflict with your current circumstances. Okay, so have a think about which timeframes that you want to use and try and stick to just the 3, just so that you have a very mechanical approach to your analysis and timeframes. Okay. So what we're now going to do is introduce actual timeframes just for the purpose of the next few examples. However, this is not timeframe specific. Okay, so this could literally be applicable to any example, providing you have, a higher time frame, a medium time frame, and a lower time frame to work with. So here again, our higher time frame being the black line. Let's imagine it's now the daily. So again, we can see that the daily time frame is clearly bearish, making lower lows and lower highs. And then we have our medium time frame, which is the blue line, and let's call that the 4-hour. Okay, so as we know, within this one daily impulsive bearish run to the downside, we have the 4-hour time frame, which is making a series of lower lows and lower highs. So let me just mark that in blue. So we now have the 4-hour, which is making a series of lower lows and lower highs, which make up that one bearish daily run to the downside. Okay. And then, as we know, once the 4-hour time frame switches bullish, we know that that is our signal that the daily pullback is now starting. Okay. And then we can just follow these bullish ranges on the 4-hour until that expectation fails. Now, as you can see here, price pulls back, okay, into that strong protected low. We then get another push to the upside, breaking structure. So this then becomes our new higher low, our new strong protected low. Price pulls back. We have a movement up, but it fails to take out that weak 4-hour high. And then, as you can see, price then switches bearish, taking out that strong protected low. Okay, so our 4-hour range at this point, let me just get rid of all of these drawings. Our 4-hour low is here and our 4-hour high is here. Okay, so that's our 4-hour swing range. And then, as you can see, we have a movement up, price pulls back, fails to put in a new higher high, and then we switch bearish. Okay, so once the 4-hour time frame has switched bearish, the 4-hour is now aligned with the daily, and that signals to us that the daily lower high is potentially forming and the swing pullback has now finished. Now, of course, we have our lower time frame being the 15-minute, the M15. So within these 4-hour bearish runs, right? We have a bearish run to the downside. We have a counter trend pullback on the 4-hour. We then have another impulsive leg to the downside. We then have another 4-hour pullback. We have another impulsive leg to the downside. Okay, so that's the 4-hour. Now, within those 4-hour runs, you can see that the 15-minute, being our lower time frame, was in fact creating a series of lower lows and lower highs, right? So as you can see, the market's just fractal. You know, the lower you go, you're going to see the same patterns over and over again. So here, the M15 is making a series of lower lows and lower highs within that one 4-hour bearish run to the downside. So once the M15 switches bullish like that, and we take out that strong protected high on the M15, that's our signal that the 4-hour pullback is now starting. Okay, so now we can look to, you know, catch these M15 higher lows, right? And then when the M15 switches bearish, so let me just draw that again. When the M15 switches bearish over here, that's our signal that the 4-hour lower high is now forming and the 4-hour pullback has finished. And then we would just expect the M15 to remain bearish, right? Which is obviously that full-blown trend within that one 4-hour bearish run to the downside. And then once the M15 switches bullish again and price takes out that strong protected M15 high, we then expect the M15 to stay bullish until that expectation fails. And then the M15 switches bearish, which then confirms to us that the 4-hour pullback has now finished, so on and so forth, right? And, you know, literally we can go through this whole price model here, but I'm conscious of your time. So if you want to take it one step further, you can see that we also have the 1-minute time frame here as well. So I'll just go through this one last time. The 4-hour time frame switches bearish, which then confirms the daily swing pullback is over. Then the M15, as you can see here in orange, switches bullish to facilitate this 4-hour pullback. Now, if we wanted to try and catch the very start of this 4-hour lower high, what we could do is jump into the 1-minute, okay? Because as we know, the market's a fractal. So what we're now going to do is just look at this price model up here. So as we can see in orange, the M15 is bullish, okay? Making higher highs and higher lows to facilitate the 4-hour swing pullback in blue. Now, of course, the 1-minute time frame is going to first have to switch bearish to facilitate the M15 pullback, okay? So hopefully you could see with this black dotted line, that being the 1-minute time frame. So let me just mark this out in black. So the 1-minute makes a series of higher highs and higher lows, which make up that one impulsive leg on the M15. Now, what can we do to anticipate when that M15 is going to start pulling back? Well, of course, what we can do is hop into the 1 minute and wait for it to shift bullish. So as you can see, the 1 minute is clearly bullish, making a series of higher highs and higher lows. So it's making a full-blown trend within that one impulsive leg on the M15. So how can we anticipate when the M15 is going to start pulling back? Well, of course, we can look at the 1 minute. So when the 1 minute shifts bearish and we get a 1 minute breaker structure, that's a signal that potentially the M15 pullback is now starting, right? So then the 1 minute shifts bearish to facilitate that M15 pullback. Then it shifts bullish, right? Which signals to us that potentially the M15 pullback is now finishing. Okay, so if we wanted to try and catch the very start of this 4 hour lower high here, we can obviously look at the 1 minute time frame. Let me just mark this out in black again. So here, the 1 minute time frame is making higher highs and higher lows. The 1 minute time frame then shifts bearish. So if we want to try and anticipate to catch this 4 hour lower high, we can jump into the 1 minute. We can wait for the 1 minute to then shift bearish, okay, which is then catching potentially the start of that M15 pullback. But as you can see, the 1 minute time frame remains bearish that whole time. We then switch bearish on the M15 as well. So now we have positioned ourselves, in the very, very start of potentially this next 4 hour impulsive leg to the downside, and we've caught the very, very start of that lower high. Now, of course, that is quite aggressive, because you're using the 1 minute time frame to anticipate a higher time frame turning point in the market. But this is what you can do once you start to understand other confluences such as supply and demand, liquidity, premium versus discount, and all of that good stuff. But really, once you understand the fractal nature of the market and the relationship between different timeframes, this is how you can catch the very start of those higher time frame turning points within the market. Okay. Now, we've just got a little bit more theory to go through, and then we will jump on the charts and we will have a look at some live price action, and we'll also have a look at some trade examples as well. So what I want you to imagine is that this is the daily time frame here like that. So we have a daily impulsive run to the downside. We then have a daily corrective pullback, and we are expecting another daily impulsive leg to the downside. Okay. Now, for the daily to pull back, the 4 hour time frame is likely going to have to switch bullish to facilitate that daily pullback. Okay. So what I want you to visualize is that the next piece of price action that we're going to have a look at is the 4 hour pullback. Now, because the 4 hour time frame is bullish, this low here is what? It's strong, it's protected. So we expect it to hold, right? Now, of course, the overall picture is that the daily is bearish. So we have to manage our expectations that this low could also fail, because if price is pulled back to an area of value on the daily time frame, then it's likely the daily is going to switch bearish, right? But we just run with the expectation that structure is going to hold until it fails. So because this low here took out that high and the 4 hour time frame is bullish, we would expect price to come down here. We would expect this strong low to hold, and we would expect the 4 hour time frame to at least continue bullish. But as I say, we have to be aware of the overall bigger picture, and the daily time frame is bearish. So we are expecting a daily lower high to then take out this daily low here, right, which I haven't actually drawn on, but imagine that's the daily low forming to facilitate that pullback, right? So hopefully that's all clear. Now, the next diagram that we're going to look at quickly should be familiar to you if you've watched part 1. This is just looking at market structure, but from one specific time frame, and then we were breaking down structure by having a look at it on one time frame into 3 different pieces of structure, okay, just so that we can understand when potentially swing pullbacks are starting and ending. And then we were also looking at internal structure concepts as well, okay. So I'll quickly go through this one last time. So we have our swing structure, which is what I'm drawing out now. This piece of structure here is significant enough to be a swing pullback. So that is a swing pullback. We then get a break of structure. After a break of structure, we expect a pullback. Now, how can we anticipate when that pullback is starting? So if you remember from part 1, we looked at 3 different types of structure. We looked at change of character, being the fractal structure, being the most aggressive form of structure break. And then we looked at internal breaks of structure, which confirmed to us the start and end of our swing pullbacks. So again, I'm not going to go through this in too much detail because hopefully you would have watched part 1, but essentially a change of character confirms the start and end of an internal pullback. The internal structure then switches bearish, which confirms to us the start of the swing pullback. The internal structure remains bearish, right? We then get a bullish change of character, which signals to us the start of the internal pullback, but the fractal structure remains bullish, leading to a bullish IBOS, right, with the internal structure switching bullish, which confirms to us the end of the swing pullback. And then once we have full structural alignment with the internal structure aligned with the swing, this is a super high probability area to get long to then target that week high. Okay, so hopefully that all makes sense and you've had a good opportunity to watch part 1 as well, as we covered that in a lot more detail. So this is the last piece of theory that we're going to have a look at in this video, and this is basically where we apply everything that we've learned within this market structure masterclass so far, bringing all of the concepts together so we can really start to paint the picture of how everything is connected and also start to build high probability trade ideas. Okay, so as you remember, just a very, very quick reminder, we have our daily time frame, which is bearish. We have the 4-hour time frame, which is bullish to facilitate the daily swing pullback. And we're now going to look at this piece of structure here, which is the 4-hour pullback. Okay, so hopefully that makes sense. So as we know, the 4-hour time frame is overall bullish, right? And it's likely just switched bullish to facilitate that daily higher time frame pullback. Okay, so our higher time frame in this scenario is the 4-hour, it's in black. Our medium time frame is in blue, and that's the 15-minute. And our lower time frame in orange is the 1 minute, okay, which we're going to use to time our entries. So as I say, the 4-hour time frame is bullish. This is a significant swing pullback on the 4-hour time frame. We then have a 4-hour break of swing structure. So then after that break of swing structure, we would expect a swing pullback, right? But it's not until we get a 4-hour bearish IBOS that confirms the swing pullback is starting. So up here, you can see we have a 4-hour bearish change of character, which signals the start of the internal pullback. So upon that 4-hour change of character, you can look to get short, but it is quite aggressive because you are still trading against the bullish internal trend. But if you want to be aggressive, then you can look to try and get short from here, just to play a little move back down into this strong protected internal 4-hour low. But it's not until we get a 4-hour IBOS that confirms the start of the 4-hour swing pullback. Now, you can notice that this 4-hour bearish IBOS is also a 15-minute break of swing structure. So you'll notice that this happens a lot, that, for example, a 4-hour internal low or high will in fact be a 15-minute swing high or low, okay? So once we see a 4-hour bearish IBOS, which is also an M15 break of swing structure, that confirms the start of the swing pullback. So now we can look to catch these M15 lower highs, right? And we can look to target these weak lows. And we would just expect the M15 trend to remain bearish until it switches bullish. So the M15 in blue has likely just switched bearish to facilitate this larger 4-hour swing pullback. Okay, but of course we can look to try and catch each of these M15 lower highs to target these weak lows, catch the M15 lower high, target the weak low, so on and so forth. However, you just need to be mindful that, the lower this M15 bearish trend goes, we are now coming into, the extreme of this 4-hour leg, into the discount of the leg. So, selling this lower high is lower probability than selling this lower high because you are lower in the leg, right? So as we come down into, the discount of this 4-hour swing leg, you can see that the M15 internal structure switches bullish. Okay, so we have an M15 bullish IBOS, which, as we know, confirms the start of the swing pullback. Now, our M15 swing high is here, and this is our M15 week low. The internal structure has switched bullish because we have an M15 IBOS, and we can look to try and catch this internal high low here, but we need to be mindful that this is a strong protected M15 swing high. So it's not until we get an M15 break of swing structure that we have that true confirmation that the M15 swing trend is now shifting. So as you can see, the M15 internal structure remains bullish, leading to an M15 break of swing structure, which is also a 4-hour bullish IBOS. What would that 4-hour bullish IBOS confirm to us? It would confirm to us that the 4-hour swing pullback has now finished. So of course we now have true structured alignment with the M15 and the 4-hour time frame. So it's highly likely that this is the 4-hour higher low in place. Once we have that M15 break of swing structure, what would we expect? We would expect a swing pullback. How can we anticipate when that swing pullback is likely starting? Well, we could wait for an M15 change of character as our first signal, or an M15 bearish IBOS. So if we were to now have a look at the 1 minute time frame in orange, the 1 minute would obviously have to switch bearish to facilitate that M15 swing pullback, right? But because the 4-hour swing structure is bullish and the M15 is also bullish, we would only expect the 1 minute time frame to temporarily switch bearish to facilitate this M15 swing pullback. Okay, so yes, we can look to try and sell from here after this M15 bearish change of character, but it's low probability, right? Because it's against the 4-hour and the M15 swing structure. So the highest probability trade idea would be to try and catch this M15 higher low. And because we have true structural alignment with the M15 and the 4-hour, we can now look to target this weak 4-hour swing high, right? It's weak because it has failed to put in a new lower low and take out that strong low. So let's just see how this would look when we start to apply the risk to reward tool, okay? So as we know, we can look to try and sell this 4-hour internal pullback upon a 4-hour bearish change of character, but it is still relatively aggressive because the internal structure is still bullish and the M15 is still bullish as well. So it's not until we have that 4-hour bearish IBOS and that M15 break of swing structure as well that we have true confirmation that the swing pullback is now starting. So once we have that bearish IBOS, which is also a break of swing structure on the M15, we can now wait for price to pull back into an area of value, into a decent supply zone, right? And then we can look to try and catch that M15 lower high, which is a pretty decent and high probability trade idea in anticipation of catching this 4-hour swing pullback, right? Because you have some decent risk to reward, whether it's down into the EQ of that swing leg or even into, a 4-hour demand zone. Whatever it is, you have decent risk to reward on your side, okay? And then of course, we just expect these M15 ranges to remain bearish until they fail, until price switches bullish again. But we just need to be mindful that, selling slightly lower in the leg becomes lower probability because of course that 4-hour swing higher low could start to form at any point when price enters, like the discount of the range or comes into a decent area of 4-hour demand, etc., etc. Okay. And then when we see the internal structure switch bullish, we can look to try and get in long just to play this M15 swing pullback, maybe targeting that weak internal high or maybe even up into some extreme supply like that. And then once we see the M15 swing structure switch bullish again, which in most cases will also be a 4-hour bullish IBOS, we can then wait for the M15 to pull back into an area of value, whether that's, the discount of that M15 swing leg into a decent area of M15 demand. And then of course we can look to try and catch that M15 higher low and then target that weak swing high. You might even just want to target the weak M15 swing high, but of course when we have true structural alignment with the M15 and the 4-hour, it's high probability to target this weak 4-hour swing high, okay? So if you want to take it one step further, you can then of course drop into your lower time frame. right? The 1 minute in orange. And then what you can do is you can wait for the 1 minute structure to switch bullish again, okay? So as you can see, the 1 minute switch is bearish to facilitate that M15 swing pullback. We have a movement lower. Let's say that we mitigate some M15 demand, and then the 1 minute time frame switches bullish. This will likely be an M15 change of character, which is fractal structure on the M15. Once you have a 1 minute breaker structure or a 1 minute change of character or whatever entry model that you want to use, essentially what you want to do is you want to wait for the 1 minute structure to switch bullish. You want to wait for 1 minute order flow to fail, and then you can look to get long to catch this 1 minute higher low, which is where you have all timeframes aligned bullish because you have your 1 minute, M15 and 4 hour all aligned bullish. So it's, you know, basically like all systems go. It's the highest probability setup that you can get because, well, as I say, all timeframes are aligned bullish, and then you can look to get long from a decent 1 minute POI, again, whatever your entry model is, and yeah, look to target that weak 4 hour swing high. So obviously, you know, pretty textbook utopian examples here. So what we're now going to do is jump onto the charts, apply this theory into practice, see how it all looks, and we'll also have a look at a few trade examples as well. Okay, so we're now on TradingView and we're looking at euro dollar again on the forex.com data feed, and you can see that I've split the screen into 4 separate charts. So we have the daily time frame in the top left, the 4 hour time frame in the bottom left, the 15 minute in the top right, and the 1 minute chart in the bottom right. Now let's imagine that our higher time frame is the daily, our medium time frame is the 4 hour, and our lower time frame is the 15 minute. Now, if you want to use the 1 minute for your lower time frame execution, then perhaps the 4 hour would be your higher time frame and the 15 minute would be your medium time frame, so your intraday bias. Okay, so we're just going to look at these 4 time frames for now. We're going to start on the higher time frame, so the daily. We're going to work our way down all the way into the 1 minute, just applying all of that theory and those concepts that we've just been through, just to see how it all comes together in reality. And we're also going to have a look at a few trade examples as well. So let's get into it, and we'll start with the daily time frame. So the first thing that we want to ask ourselves is, are we bullish or bearish? And I think we can all agree just by looking at this chart, you know, it's clearly bearish, right? Making a nice, pretty clean sequence of lower lows and lower highs. So I'm just loosely drawing what I deem to be the swing structure on the daily time frame. Now, of course, some of you may have mechanical pip rules for the daily chart, which is great. But I'm just going to apply a little bit of discretion here, and I can see that that's clearly a swing pullback on the daily time frame. Right, we had a nice impulsive run followed by a corrective pullback, followed by another impulsive run to the downside, right? So it's about as clean as it gets, really. So I'm quite happy to call that my daily swing low. And as you can see, we had a daily break of swing structure here. So daily boss. Following the boss, we can then look back and we can now find our confirmed swing high, which would be there. Okay, so we have our daily swing high. I'm just going to mark that with that line there, just so that we've got our range, daily swing high. Okay, after that daily breaker structure, you can see that price did start to pull back, but it was a pretty shallow pullback, right? And then we had another movement to the downside, but notice how price failed to break and close below this low here, right? Which was the start of that first pullback. So we have what's called a liquidity grab, which again, we haven't covered yet, but some of you may be familiar with that, right? We've had a daily liquidity grab, which has then fueled this next move higher. So what I'm going to do is just quickly mark that as a daily liquidity grab. Put my little fancy liquidity sign there, right? So if we just focus on this internal piece of price action quickly, what we can see is that the daily time frame started to pull back a little bit. We had a movement to the downside, and then you can see we had this movement to the upside. Of course, all contained still within this swing range. So this is internal structure, but what we can see is that we now have internal structure to work with. So we have a bullish IBOS, right? So what that confirms to us is that the internal structure has now switched bullish, which confirms the start of the swing pullback, right? So I'm now quite happy to call that my daily swing low. Again, you might measure that and say, okay, well, that's a significant pullback on the daily time frame, so I'm happy to call that my swing low as well. So we know that the internal structure has now switched bullish. So that means that this daily weak swing low is in fact actually a strong internal low. Now, sometimes structure is going to be misaligned, but if it is misaligned, just remind yourself that swing is king, right? It's always going to take precedence over internal structure, okay? So yes, the internal structure has switched bullish, but it's likely just switched bullish to facilitate this swing pullback, okay? So price has now pulled back into an area of value, okay? So we're not really going to get into like supply and demand and premium versus discount and liquidity and all that good stuff because I want to save that for another video. But essentially price has now pulled back into a high probability daily supply zone, and we've seen a pretty decent reaction. So it's possible that the daily objective is now complete because we've mitigated a high value area here on the daily time frame. But we also need to be aware in the back of our minds that, of course, the internal structure is bullish and can stay bullish, right, to potentially mitigate, like the extreme of this leg. And it's not until we get a bearish IBOS that then confirms the end of the swing pullback, right? So that's always a possibility. But as I say, if structure is misaligned, just remind yourself that, swing is king, and particularly if price has mitigated, a high value area on that specific time frame, then it's very possible this internal trend will then switch bearish because price has more than likely completed its mission, okay? So this high is in fact a weak internal high, and this low here, although it's a weak swing low, it's actually a strong internal low, okay? So that's the daily chart. Let's now go down to the 4 hour. I'm just going to make sure that that's on the 4 hour. Right, so let's have a look at the 4 hour chart. So if we just zoom out a little bit here, we can see that, let's just focus on this recent piece of price here just to kind of speed this up a little bit. But that's a pretty significant 4 hour swing pullback. So I'm happy to call that a 4 hour swing pullback. And as you can see, we get a 4 hour break of swing structure just here, okay? Which means that we then look back and we find the highest point that led to the break, which of course is this high there. So that's our 4 hour strong swing high. And then we start to pull back, we get a pretty decent pullback here on the 4 hour time frame, and this move here breaks, this level of structure and this supply zone. So it's a pretty decent 4 hour pullback. So I'm quite happy to call that my 4 hour swing low. So as you can see, the 4 hour internal trend on the 4 hour chart remains bullish and eventually takes out the strong 4 hour swing high, okay? So now the 4 hour trend, if I just in fact get rid of that for a second, the 4 hour trend has now switched bullish, which as we know was also a daily bullish IBOS, okay? So where's our swing low? Well, it remains the same, okay, because that's the lowest point that led to the break. So after that break of structure, we then get a little pullback here on the 4 hour, but to be honest, that doesn't really look like swing structure to me relative to these, other swings in price. So that would just be internal structure. We then have another pretty decent move to the upside. Let's look left. What are we reacting to? Okay, well, we've come into this supply range, okay? We've started to react. And as you can see, we then have a pretty aggressive move to the downside, breaking this internal low. So let's mark this out. So we have a bearish IBOS there. So H4 IBOS. Okay, so now the internal structure has switched bearish. So I'm quite happy to call that my 4 hour swing high, right? So if I just put that little dot there just to keep it all nice and clean, right? So we know that the 4 hour swing structure is bullish. So this being our 4 hour strong swing low, this being our weak 4 hour swing high, but we know that the internal structure has now switched bearish, okay? So it's not until the 4 hour internal trend then switches bullish again and we get that bullish IBOS that confirms the end of the swing pullback. Now, this is again the beauty of multi-time frame analysis, right? Because we know that the daily swing trend is bearish, and now the 4-hour internal trend has also switched bearish. Okay, now of course we need to be mindful that this is a strong 4-hour swing low, and the 4-hour trend is still bullish. And yeah, you know, the 4-hour may come down here to this extreme, and this is potentially where the 4-hour high low will form to go on to take out that weak swing high. But we also know that the daily time frame has mitigated a pretty decent area, you know, premium level of supply, and you know, we've seen a very aggressive reaction from that level. So it's possible that now the internal trend will remain bearish until we take out this strong 4-hour swing low. But of course, we also know that it's a weak daily swing low. Okay, and of course the daily is more powerful than the 4-hour time frame, so we just need to manage our expectations. So basically you can start to build a case for both long and shorts, because of course structure is out of alignment. You know, you've got a daily swing trend which is bearish, you've got the 4-hour swing trend which is bullish, but now when you start to piece everything together and you're like, okay, well, price has now mitigated a pretty decent area on the daily, the internal structure has switched bearish. We've seen a ton of momentum, which has led to this, you know, pretty decent break of 4-hour internal structure. And now price is just correcting sideways. What do we know about the natural progression of the market? Price typically moves in an impulse corrective fashion, right? So it's very possible that actually we see an impulse, a correction, and that continuation, and then the 4-hour swing trend switches bearish. Okay, so yeah, that's the 4-hour chart. Let's now go to the M15. So let's just open this up. And again, what we need to do is just look left to build the story, to establish whether or not we're bullish or bearish, and to really know where our accurate swing highs and swing lows are. Okay, so what we'll do is just look left a little bit. So just up here, that would be the 4-hour weak internal high. So you know, that's a pretty clear M15 swing pullback, right? So I'm quite happy to call that an M15 swing pullback, M15 swing high. We pull back, and then we get an M15 break of swing structure over here. So M15 boss, right? So where's our swing low? Well, of course, this is the lowest point that led to the break. So our M15 swing range is from this low to this high, right? So as you can see, after that break of structure, we get pretty expansive move to the upside, and then price starts to correctively pull back. So let me just have a quick look where we pull back to. Okay, yeah, so we pull back to the EQ of that range. We also mitigate this prior demand range as well. And then as you can see, after pulling back to the prior range, price fails to take out the weak swing high. And then we see a pretty aggressive sell-off. I can't quite remember what that was, but I think it was CPI news or something like that. But yeah, we then get a really aggressive move to the downside. And then as you can see, the M15 swing trend switches bearish. So let me just get rid of that. And then we will mark on our M15 break of swing structure like that. Okay, so this high up here, as we know, it was a weak 4-hour internal high. Okay, but it now becomes our strong M15 swing high. Okay, because that's the highest point before the break. So we continue to trickle lower, and now, you know, this looks like a pretty significant pullback here on the M15. Again, if it just helps, you can always measure it, right? So you can measure it from the low to the high, and you know, that's over 65 pips, so it's a sizable pullback as far as the M15 is concerned. So, you know, I'm quite happy to call that an M15 swing pullback, right? So at this point, you know, we're playing within a pretty large M15 range, okay? So let's play a few more candles forward just so that we've got a little bit more structure to work with. Right, so let's have a quick look there. As you can see, price hasn't actually broken and closed below the low yet, right? So if you can see from the crosshair, if I just zoom in there a little bit, you can see that price has failed to break and close below the low. So now it looks like, okay, so we've just broken below that M15 swing low. So if we are being 100% mechanical, you can see that this candle here has now, the body of that candle has broken and closed below our swing low, which means that we can now find our new swing high. So that being this high there, right? That's the highest point before the break. So now we're playing within this new M15 swing range. So if I just mark this as our strong M15 swing high, okay, so we don't know where our swing low is at the moment because of course we need to wait for structure to develop. So just looking at the M15 time frame alone, you could potentially look for some shorts from, this whole supply range, okay, if you wanted to. Or of course you can wait for price to mitigate this supply range, jump into the 1 minute, and then wait for the 1 minute time frame to shift bearish, right? And then of course you can use the 1 minute just for that added accuracy and timing, and of course increase your risk to reward. All right, now that is not the most convincing break, so I'd be a little bit cautious, but being 100% mechanical, it is a confirmed break of swing structure, meaning that we now have our new strong M15 swing high. Okay, so let's just play a few more candles forward, right? So we mitigate that M15 supply zone. It doesn't look like we come to that refined candle there, so we actually just mitigate those buy to sell wicks by the looks of things. Okay, and price has currently failed to take out the low, and now as you can see the internal structure has shifted bullish, right? So now we have a bullish IBOS on the M15, right? So now that confirms the start of the M15 swing pullback, but notice how first of all it's super impulsive, second of all that's not the most convincing break of structure, third of all we failed to take out this low again, right? So I wouldn't now be surprised if the swing trend switched bullish, okay? Now, it's not until we get a bearish IBOS that confirms the end of the swing pullback, right? So let's just play a few more candles forward, right? It's a big move, right? Breaking that high. So now the M15 has switched bullish. No surprise there, really. Okay, so now the M15 has switched bullish. We can look for reasons to get long, playing this pro trend M15 move, right? Because the M15 has switched bullish. Now we're also aware of the bigger picture. Let's just quickly hop back to our other time frames, right? So we go back to the 4 hour. We know that the internal structure on the 4 hour has switched bearish. So just thinking about what's happening on the 4 hour from an internal perspective and the M15. Now the M15 has switched bullish, right? Even if we're to get long playing that M15 pro trend move, even if we can get in long just to play that 4 hour internal pullback, right? Because it's possible that, the 4 hour pullback into this supply zone here before continuing lower, it's potentially into the extreme of this 4 hour swing leg, and then let's see what happens, right? So as we know, the M15 swing trend has switched bullish. So, we've kind of got to ask ourselves, well, the M15 has switched bullish, but likely just to facilitate this 4 hour internal pullback, right? So go back to the M15. So in terms of the M15, we know that we switch bullish. This low then becomes our new strong protected swing low. Now within this leg of price, we've got a couple of zones. We've got this zone here, we've got this inside bar. It's not the best. And then we've also got the extreme down here. And pretty much everything below this extreme has been mitigated. So this is a super high probability POI to get long from. Okay, and just to kind of add a little bit of confluence to this zone, it also flipped this level of supply, and it also led to that internal break of structure, right? Taking out multiple supply zones along the way. So some big money stepped into the market here, leading to that M15 break of swing structure as well. So it's a high probability POI to look for longs. Now, this is still valid. It's just about sat on the EQ of the leg. But I'd be very cautious that this zone here would be used as inducement for the extreme, okay? So let's just play a few more candles forward and see what happens. So if we just look at all of these candles here, right, we have a movement to the upside. We then have an internal pullback because that inside bar if you were to look at the 1 minute, it would look something like this on the 1 minute, right? So we know that just by looking at that inside bar there on the 15 minute, it's more of a lower time frame pullback, right? So if price was to break that fractal low there, that would be a bearish change of character, right? Now, sometimes the fractal structure, so CHOC, and those larger internal pieces of structure are sometimes going to be the same. Okay, now this is a pretty good example of that, where we have, just pretty much one straight push with a very small fractal pullback in that leg. Okay, so if price was to break that fractal low, that would be a bearish CHOC, and that would also be a pretty good signal that, we're going to come a little bit lower to potentially into this extreme. Okay, so I'll just play a few more candles forward. So we initially react from this zone, and it's possible. Let's just take our premium versus discount. It's not quite on the EQ, right? So typically price does like to mitigate the EQ of a swing leg, and that hasn't quite happened yet. So there's always the possibility that this reaction from this demand is just to build liquidity to fuel some lower prices. So let's have a look at what happens. So this is pretty corrected price action. No surprise really throughout the Asian session. And then sort of coming into the start of London, as you can see, this demand now fails, right? So internal order flow is now bearish. That would be a bearish change of character. Okay, now we have to ask ourselves, why has the internal structure switched bearish? Well, likely just to mitigate some discount demand within this swing leg, okay? So there's a couple of ways in which you could approach this. The first way is that if the M15 is your execution time frame, right, so your lower time frame, you could simply set a limit, right? You could set a buy limit on this POI like that, depending on what your rules are, right? So maybe you're going to go on the distal, maybe you're going to go on the EQ, depending on whatever your rules are. And then, the simple target, the logical target would be the M15 swing high, which I haven't marked. So that's our weak M15 swing high, because at the moment it's failed to put in a new low. So we are playing within this M15 bullish swing range, right? So now that prices come into the discount of this range, this is a pretty decent area to look for longs. So your first option, if the M15 is your execution time frame, you could literally set and forget an order on the extreme of this range, okay? Or what you could do is you could wait for price to mitigate it, if it was going to mitigate it, and then you could wait for an internal bullish breaker structure, because then the internal structure is aligned with the swing structure. So that just increases the probabilities a little bit more to confirm that, okay, this zone is going to hold. And then once the internal structure has switched bullish, we now have full structural alignment to target that weak swing high, right? So that's your second option. Of course, your third option is that once price mitigates this M15 demand zone, you can then jump into the 1 minute or a lower time frame than the M15, whether that's the M2 or the M5 or whatever. And then you can wait for a specific entry model from this zone here on the lower time frames. Or what you can do is again wait for the internal structure to switch bullish. You then have some fresh demand to work with, and then you could simply drop into the lower time frames once you have that freshly created fractal demand. Okay, so there's a couple of options really on how you can get involved in these trades. So what we'll do is we'll just set this first entry here, using the 15-minute time frame. So you'd now be triggered into that trade. Notice how if you were to enter on the EQ of that zone, you would have been triggered, right? And of course you would have had a bit of a tighter stop, something like that, 7 pips, targeting the week high for almost 10R. Okay, so that's one way of entering on the M15, looking to play that pro trend M15 move, which as we know is likely just to play that 4-hour internal pullback as well. So let's just keep playing a few more candles forward. Let's see what happens if this zone, okay, so now that zone has held, right? Now we've seen a pretty decent move from this level. So let's just get rid of that for a second, bring it across. So now what we can see is a bullish IBOS, right? So price has clearly broken that high there with a lot of momentum. So now we have true structural alignment with our internal and our swing, right? So probabilities have now increased. So that bullish IBOS confirms the end of the swing pullback. So now the probabilities are increased even more that this is the swing higher low in place, and we can now target that weak swing high with a lot more confidence. So as I was saying, right, because we have this bullish IBOS and we have this shift in internal structure, we now have new demand to work with, right? So we have this freshly created fractal demand. So again, just purely looking at the M15 timeframe alone, you could simply enter on this zone here, right? Just going on the distal again, targeting that weak swing high, something like that, okay? Absolutely fine. So what we'll do is we'll just see what happens there. Right, so you're now triggered into that trade. So that's now running. Okay, now as I say, if you want to take it that one step further, you can now drop into a lower time frame. So what we'll do now is have a look at the 1 minute and see how we could have got involved in this, right? After that bullish IBOS, once the internal structure has aligned itself with the swing structure, and yeah, we'll just see how we could have got involved in that particular trade. So I'm just going to make sure that everything is showing from a 1 minute perspective. And now we're going to hop to the M1, okay? So I'm not gonna go through all of this because I'm conscious of your time and I don't want this video to be 4 hours long, but what you can see here is that this impulsive move higher on the 1 minute is what led to that M15 bullish IBOS. So if we just mark this on the 1 minute, so that's showing, and now we'll hop back to the M1, right? So price initially mitigated this discount demand, kind of messed around for a little bit, right? Obviously building liquidity, swept liquidity, and then eventually we saw that pretty impulsive move higher, leading to that M15 bullish IBOS. So now we have this newly created fractal demand to work with. So, you know, if you were going to use the 1 minute for your lower time frame entry, you would literally set an alert on the edge of this zone, or maybe just in front, and then you'd wait for the 1 minute time frame to mitigate your zone. And then depending on what your entry model criteria is, you could then wait for a specific pattern to occur to see if you can use the 1 minute to position yourself in a long to catch that next M15 run to the upside, okay? So let's just play a few more candles forward. Okay, so price has now mitigated our POI, right? So as you can see, the 1 minute time frame, if I was just to draw this, you know, using a line, for example, the 1 minute time frame is bearish, right? So as we know, what we need to wait for is the 1 minute time frame to shift bullish, okay? So there's nothing at the moment, unless of course you were going to, you know, set a risk entry on a refined zone like that. But to be honest with you, it's pretty low probability because there's no inducement in this leg and the extreme is also still unmitigated. So yeah, setting a risk entry on that 1 minute sort of refined candle is pretty low probability as far as I'm concerned, but don't worry about that too much. So let's continue to play price forward. So at this point here, if I just zoom in, you can see that we just have what's called a change of character, right? So a chock. So that's the fractal structure in terms of the 1 minute shifting bullish, okay? So here we've had a pretty decent sweep of liquidity. We have strong momentum coming out of our POI. So this is called a V-shaped reaction. And now we have a 1 minute change of character. So let me just continue to play price forward for a minute. Okay, so you could enter from this POI like that. It's pretty aggressive, and the reason why is because there's been no clear shift in order flow, right? We can see that this 1 minute supply range is still holding, and sometimes what you'll get is a change of character, and it's just a liquidity grab before price continues to move lower. Okay, and also notice how this 1 minute piece of price action remains bearish this whole time. So there's been no disruption in order flow at this point, right? But now, as you can see, we've had a pretty decent move to the upside, and you know, price is now sweeping this liquidity, and we've had a pretty clear shift in order flow, right? So now price is just kind of pulling back. So now we have another clear POI to enter from, which it's just slightly higher probability in my opinion, because now we have a clear shift in 1 minute order flow, and yeah, price is now starting to correctively pull back. So now we're just sort of building liquidity in front of this 1 minute demand zone. So we can look to enter from here with a 3 pip stop is absolutely fine. Now, again, depending on your management rules, some people like to target a fixed 5R, which would be that. Some people like to target their nearest weak leg, which would be this high here. And of course, we can also target that weak M15 swing high with a lot more confidence, because the internal structure has now shifted bullish in line with the swing. So we have almost an 18% trade there if this was to, of course, play out, right? So let's just see whether or not we get triggered into this position. So, okay, we haven't quite got triggered yet. Now, a couple of things here. Price may have just mitigated this M1 demand range, as you can see, right? And sometimes if you over refine your 1 minute zones like that, then sometimes you can miss trades, right? But of course, this move here might just be to build liquidity in front of the POI, right? So, in which case that would increase the probability of this zone even more, because it has inducement in front of it. Now, don't worry if you're not familiar with any of these terms that I'm going on about: inducement, supply and demand, and liquidity, and all of that good stuff. But of course, you can find out more about how we trade within our Zero to Hero course if you want to check out our platform. So let's just continue with this. Right, so price is correcting. We still have our order set on this 1 minute POI like so. Let's see what happens. Okay, so we would have now been triggered into the trade. Okay, so at that point there, again, if you were going on the EQ, you'd have an even tighter stop. You'd have a 2 pip stop, or maybe a 1.5 pip stop. But to be honest, you don't need anything less than 2 pips, really. I think 3 pips for euro dollar is a great sweet spot if you're using the 1 minute time frame for your entries. So let's just put it back to how it was. We entered on the open of this POI, right, the distal, and now you can see that we've had a pretty decent move higher, taking out this high here. So for me personally, I'd be happy to remove my risk upon that structural break, right? So again, depending on your own management rules, you're going to manage this a million different ways, but here you can see that price has now met that internal weak high, and we're continuing to push higher. So let's quickly hop back to the M15 and we'll continue playing this. So we have 3 entries, right? We have our first entry, which is essentially the lowest probability entry that we've discussed, because as you can see, internal structure and order flow is bearish. So essentially buying here is trading against that internal order flow and structure. Price then shifted bullish. We had our bullish IBOS, and then we have our second entry here, which is much higher probability as the internal structure is aligned with the swing structure. And then of course we dropped into the 1 minute just to refine that entry a little bit more, and then we waited for that 1 minute order flow and structure to shift bullish after mitigating this M15 POI, which is that third entry that we have running at the moment, right? So we have these 3 trades. Doesn't mean that you have to take all 3 of them, right? You just have to find what works for you. How aggressive or conservative do you want to be? How much confirmation do you want to have? Okay, so let's just continue to play this forward and see what happens. So nice move to the upside. We've had another internal break of structure here. So this low becomes a strong protected internal low. So again, maybe you'd want to try and catch that next M15 internal high low. Who knows? Because we just expect these internal ranges to remain bullish until we take out that weak swing high. So let's just keep playing this, see what happens. Okay, wow. So there we go. We've now taken out that weak M15 swing high. So yeah, 3 great trade examples there, just to showcase how we can kind of start to piece all of these concepts together, just to understand how that framework really comes together in reality. So now that we've been through a couple of trade examples on the M15, I'm just going to quickly hop back to the 4-hour time frame, okay, before we wrap this video up. And now we're going to play a few more candles forward just so that we can see what happens, right? So you can see that this move here on the H4 was obviously the M15 switching bullish. Price has now, swept these highs, right? And it's mitigated. It's pretty insignificant level on the 4 hour. We just got these buy to sell wicks, so yeah, nothing that significant at all. But essentially, price has pushed higher. It's failed to kind of close above these highs here, right? We're seeing strong impulsive momentum, very corrective price action. So I'll keep playing a few more candles forward. And now you can see that we're starting to pull back. And there's always the possibility that this internal trend continues bullish, right? As I said, to mitigate this extreme of this internal leg, because of course this is a strong internal high. We know it's a weak 4 hour swing high, but it's a strong internal high, okay? So let me continue to play a few more candles. Still pretty corrective price action, right? Sweeping highs. So let's continue to play this. Right, strong momentum to the downside. So if we were to quickly hop back to the M15 and just open this up, right, and zoom out a little bit, you'll notice that if we continue to play this, so just get rid of that. The M15, as we know, broke this high, okay? So it was an M15 break of swing structure. So this low here would have been our strong M15 swing low. So let me just mark that out. M15 swing low, okay. And as you can see, the M15 then switched bearish, right? So not the best price action, because essentially price is sweeping highs and sweeping lows. The M15 temporarily switched bullish, and now as you can see, the M15 has switched bearish again, meaning that this high then becomes our strong M15 swing high, right? So let me just change that quickly to M15 boss. So this high up here becomes our M15 strong swing high. Right, I'll just play a few more candles forward, and then as you can see, the M15 chops sideways and then continues to melt. So again, you can continue to follow the M15 bearish trend. Right, if we quickly hop back to the 4 hour time frame again, as we know, the M15 swing trend is bullish, the internal 4 hour trend is bearish, and the internal trend can remain bearish until we take out the strong 4 hour swing low, right? And it's not until, as I say, we have a bullish IBOS that confirms the end of the 4 hour swing pullback. So if I just play a few more candles, you can see that the internal trend remains bearish to then take out that strong 4 hour swing low. Okay, so this is why it's really important just to understand that the higher timeframes are always going to take precedence over the lower timeframes. So although the 4 hour time frame was bullish, and we'd expect this low here to hold because it's a protected low, right? Because it took out this high here. We also know that it's a weak daily low. And of course, daily structure is more powerful than 4 hour structure. Okay, so we're not surprised that it fails, especially when the 4 hour internal switch is bearish. And of course, we start to look at the nature of price, really impulsive price action, very corrective pullback, followed by this really impulsive continuation, right? Leading to that 4 hour bearish swing boss, okay? So let's quickly hop to the daily just to see how that looks before we finish up. So let's just get rid of that and we'll go through this daily time frame. So probably just gone a little bit fast there, but as we know, the daily internal trend was bullish. And of course, there was a possibility that the daily internal trend would stay bullish to mitigate this extreme. But as we know, the daily had pulled back to a high value area, and we've seen, somewhat of an impulsive reaction from that high probability daily supply zone, right? And, price has just been sort of chopping sideways since. So yeah, no surprise that we took out the weak low at this point. So yeah, as you can see, we now have a daily boss, right? So just quickly finish this up. we have a daily swing boss, which means, of course, this high here now becomes our daily new swing high, right? So there we go. I'm going to wrap this video up here. Hopefully you took some value from it. Hopefully you're now starting to see how these concepts work from a multi-time frame perspective. There's a couple of nice trade examples there for you as well to go and backtest. And yeah, please don't forget to like, comment and subscribe. Don't forget we've got the giveaway as well. We'll be announcing the winners for that giveaway as soon as this video hits 1,000 views. And of course, if you've got any questions about anything, then feel free to shoot us a DM on Instagram or send us an email and we'll come back to you within 24 hours. So appreciate the support, guys. Thanks for watching and I'll see you in the next one.